Welcome to Rich Tribe. Look, listen closely to this, because we're about to totally flip everything you think you know about money right on its head. You know, the average guy out there, he focuses obsessively on what he earns. He's always chasing that next promotion, working crazy overtime just for a slightly higher salary. But the truly wealthy, we focus on what we keep. We're zeroed in on shielding our money from literally the greatest silent wealth killer on the planet, and that's taxes. So in this explainer, I'm going to show you exactly how the ultra-rich build and protect their fortunes, and how you can use those exact same strategies to build your own generational wealth.
Okay, let's start with a foundational number here, $1.5 million. If you take just $1,000 a month and invest it in a diversified equity index fund that averages, say, an 8% return, in 30 years, you're sitting on over $1.5 million. And guys, this isn't magic. It's just the mathematical certainty of compounding. Your money makes money, and then those returns generate their own returns. It's kind of like a snowball rolling down a hill, building immense wealth over time.
Now contrast that $1.5 million with what happens if you decide to just play it safe. If you take that exact same $1,000 a month and just leave it sitting in cash, like in a basic checking or a flat savings account, you end up with just $360,000 after those exact same 30 years. I mean, that is less than a quarter of the wealth. You are quite literally leaving over $1 million on the table simply by playing it safe with flat cash.
Hold on, wait a second, Richard. I mean, that $1.5 million sounds amazing on a spreadsheet, right? But let's talk reality for a minute. Won't the IRS just swoop in and eat like half of that compounding growth in taxes before I even get a chance to spend a dime of it?
Okay, let's dive into this, Monique, because you just hit the nail on the head. This is the exact reason most people never really get ahead. See, the wealthy don't just invest, they invest in the right vehicles. You've got pre-tax or traditional accounts, like your standard 401k. Those lower your taxable income today, so if you make 75 grand and put in 5 grand, you're only taxed on 70 grand this year. But then you have post-tax or Roth accounts. Think of it like farming, okay? You pay taxes up front on the seed, but, and here's the millionaire secret, that money grows completely tax-free and you get to keep the entire harvest completely tax-free in retirement. No IRS swoop-ins whatsoever.
Right, okay, but you're talking about retirement. Why on earth would I lock my money up until I'm 60? I've got bills today, you know? I want to actually enjoy my wealth right now while I have the energy, not when I'm old and gray.
Honestly, that's a super common fear, but it's a massive trap. Look, the 401k was only established in 1978 and the Roth IRA in 1998. These are modern tools. I mean, the Roth IRA is barely older than a millennial. Before these even existed, everyday earners just didn't have a structured way to build a dignified, independent retirement. The government designed these tools specifically to shield your hard-earned cash from taxation. If you ignore them just because you want cash right now, you're honestly committing financial self-sabotage. You secure wealth for later so you can have total peace of mind forever.
Fair enough. But let me ask you this, Richard. Does it actually matter what I put inside these accounts? Like, if I'm maxing out a Roth or a 401k, is it just about aggressively throwing the money in there? Or is there some specific strategy the wealthy are using?
Oh, it matters tremendously. We are stepping into some real high net worth territory right here. What you're asking about is called asset location. That's the strategic placement of assets to maximize your after-tax growth. Because look, buying a great asset, that's only half the battle. Where you hold that asset dictates how much of the profit you actually get to keep. You absolutely have to protect your tax-inefficient investments from the IRS.
So here's exactly how you execute that strategy. Index funds and ETFs, they're highly tax efficient because they just passively track the market, so you can safely keep those in normal taxable accounts. But active funds and bonds, they generate ordinary income, which gets taxed heavily year after year. You want to hide those in tax-deferred accounts, like your 401k. And finally, those high-growth equities, the really explosive stocks you expect to multiply in value, you lock those into a tax-free account like a Roth IRA. If that stock goes up 1,000%, you owe exactly zero in taxes on that growth. Boom. That is how you maximize your bottom line net return.
Okay, that makes total sense for growing the money efficiently. But here's the ultimate dilemma for me. If literally all my wealth is tied up in real estate, stocks, and these tax-advantaged accounts, how do I actually buy things? Like, if I want to buy a house or fund a business, won't selling those assets just trigger a massive capital gains tax bill?
Monique, you literally just asked the million-dollar question. And the answer is a wealth retention strategy coined by Ed McCaffrey called Buy, Borrow, Die. Now, I know the name sounds a little intense, but this is the exact playbook the ultra-rich use to avoid taxes entirely. And let me be super clear about this. They aren't using illegal loopholes. They are using strategic leverage.
So here's how it works. Step 1, buy appreciating assets, like real estate or strong equities. Step 2, and this is the absolute masterstroke. Instead of selling those assets when you need cash, you borrow against them. Taking out a loan is not a taxable event. The IRS does not tax debt. So you get the tax-free cash to live your life, and your original assets just keep compounding in the background. Step 3, die and pass those assets to your heirs with what's called a step-up in basis. That basically means the IRS resets the value of the asset to the day you pass away, totally wiping out all the taxable gains from your lifetime. Your kids owe no capital gains taxes on that growth. Now, a quick word of caution here. Borrowing requires serious discipline. If asset values fall aggressively, a lender might ask for their money back. But if you manage it correctly, this is an absolute fortress for generational wealth.
Now, another strategy we use on a daily basis is tax loss harvesting. Let's say you own some Apple stock and the price temporarily drops. Instead of panicking, a wealthy investor will sell it to purposefully realize the loss. Why? Because you can use that loss to offset your capital gains somewhere else in your portfolio and even reduce your ordinary taxable income by up to $3,000 a year. You then immediately reinvest that money into a similar ETF so you stay in the market. You are literally turning a market dip into a direct tax deduction.
Now, before we get to the absolute most important wealth habit you need to start today, make sure to subscribe to Rich Tribe channel, like, comment, and share this explainer. Seriously, if you want to keep learning the closely guarded secrets of the wealthy and build your own financial fortress, you need to be part of the tribe. Go ahead and hit those buttons right now.
Okay, buy, borrow, die, and tax loss harvesting sound incredibly powerful for billionaires and high net worth families, sure. But let's bring it back to reality for a second. For the average earner watching this right now, who's really just trying to break out of that paycheck-to-paycheck cycle, what is the ultimate wealth habit they can start literally today to get to that level?
Well, the crucial point is this. Building wealth doesn't require a six-figure salary. It really just requires daily intention. There are 5 non-negotiable habits you can start right now. Number 1, pay yourself first. You've got to make saving a bill that is just as mandatory as your rent or your mortgage. Number 2, automate your good choices. Set up automatic transfers to your 401k and IRA so willpower isn't even a factor, especially to capture your employer match, because guys, that is free money. Number 3, ruthlessly eliminate those silent wealth killers like random bank fees and unused subscriptions. Number 4, build multiple income streams to diversify your risk. And number 5, spend intentionally, not impulsively.
Let me prove to you that it's really all about time and discipline, not just having a massive income. Think about a simple $200. If a 22-year-old saves just $200 a month and invests it in these tax-advantaged accounts, they will easily accumulate substantially more wealth than a 32-year-old who starts saving the exact same amount 10 years later. Why? Purely because of time and tax-free compounding. That is the hidden superpower of delayed gratification. You don't need a huge paycheck to get started, you just need to start right now.
Which brings us to our final question for you today. Are you going to let taxes and time silently steal your financial freedom year after year? Or are you going to take action today, use these incredibly powerful tax-advantaged tools, and build an absolute wall around your generational wealth? Look, the choice is entirely yours, but the math does not lie. Start acting like the wealthy, and you'll become one of them. Thanks for joining us on this explainer, and we'll catch you next time.